Thank you, Kim. I'd like to start with a few historical facts. I'm going to talk about bear markets, those warm, cuddly, well, sometimes they just aren't very warm and cuddly. We should know our offices are located in Whitefish, Montana, just outside Glacier National Park. With almost 40 years of research under our belt and over 100 years of data that we base that research on, Investec does have a track record for identifying those bear market warning flags. Kim mentioned the 1987 crash. We didn't forecast it in advance. We recognized the warning flags in advance. Also, the tech bubble. And this last market peak and the Great Recession, in July 2007, we published this issue titled Bear Market Warning Flags. We felt they had all dropped into place. We were moving to a very high cash defensive position. The market would peak 3 months later and drop into the biggest bear market since the Great Depression. I'm also going to talk about where we are on the Wall Street roadmap, because this is a question that most investors never ask, and yet it's one of the most important questions is, where the heck are we? Let's start with a historical perspective. And this next bar chart I put up, it's going to have a horizontal bar for the length or duration of every economic recovery since the 1900s. So it's over 100 years of data. There have been 22 economic recoveries over this past century plus. That means there have been 21 recessions. This month, this current recovery will become the longest economic expansion in U.S. history. And there are a couple points I want to make about this data and these past historical expansions. One of them is that most economic expansions last between 2 and 5 years. So this one is already about twice the historic norm. And the other thing I want to point out is the second longest and third longest economic expansions were in the 1990s and in the 1960s. And we're going to come back to those decades in a second. But by any historical comparison, this economic recovery is getting long in the tooth. I'm going to ask an obvious question. Why manage risk? After all, economic recoveries do not die by old age alone, and there are no apparent clouds on the horizon, well, other than perhaps here in Seattle this morning. The reason to manage risk is because there's a growing bear market risk. And I'm going to share another important statistic with you. In the past 86 years, there have been 15 bear markets. That means they come around about every 5 or 6 years. It's been 10 years since the last one. And I brought along a graphic showing what we call bear market repos. What are bear market repos? Well, they show how much of the previous bull market gain was repossessed or taken back by the subsequent bear market. That's how much investors gave back after the bull market ended. And here is what's surprising. 1/3 of those 15 bear markets took back all of the entire bull market's gain. And note this, almost all of them, with the exception being 1956, almost all those previous bear markets took back almost half or more of the previous bull market's gain. What's that mean today? Well, it means simply this. Bear markets are not those warm, cuddly little creatures. They can be severely damaging to your portfolio, and if you're in retirement, they can be devastating. Today, the Dow is over 26,000. It started in March 2009 at 6,600, and that means that if the next bear market were to follow normal precedent, it could easily take back well over 10,000 Dow points. Why are we worried about a bear market today, other than the fact that we have this historical respect for bear markets and the damages they cause? Well, one reason is because it is a mature economic recovery. At 10 years long, it is the longest in history now. And we do see excesses developing. We see them developing in expectations or confidence. We see them in debt. And we also see them in real estate. Yep, once again, as you know, here in Seattle very well. Let's take a look at consumer confidence, how consumers feel about the present. This data for consumer confidence goes all the way back to the 60s. Over 50 years of data up here. Consumer confidence today is near the highest level of the past half century. And in fact, if you look at that historical level, it's matched only by the latter half of the decade of the 90s and the late 1960s. Do you remember that first chart I put up a few moments ago, the longest economic expansions? They were the 1990s and the 1960s. Long economic recoveries create a complacency. They create an overconfidence. There's nothing that can go wrong. There's no recession on the horizon. And the Federal Reserve, of course, has everything under control. Here's a sample of the headlines from the 1960s. No more recessions. The official word, plan just right, be prepared to act at the first sign of trouble, and recessions can't be prevented. Yeah, right. We've had 7 recessions since then. Here's another headline from the late 1990s. Growth forever. The U.S. economy likely will not see a recession for years to come. We don't want one. We don't need one. And as we have the tools to correct the current to keep the current expansion going, we won't have one. 2 years later, we were in recession, and the tech bubble let the air out. We feel the attitude today is somewhat similar, and that's what worries us. There is no reason to have a recession, and of course, the Federal Reserve has everything under control. I want to discuss a couple of the excesses. I'm just going to touch on 2, the debt and the housing. I did not bring a chart of student debt because I think that would scare you too much. 1.5 trillion in student debt outstanding. Instead, I'm going to put up business debt. Business debt as a percentage of GDP, even though the economy's grown dramatically in this 10-year recovery, business debt is back up to the levels that it was at the last cyclical peak. And there is more low-quality corporate debt being issued and financed than there is good quality corporate debt being issued. That means that there is going to be a lot of defaults if, or rather when, this economy next goes into a recession. I mentioned housing. Back in 2005, we published a graphic, and we warned of what we thought was a housing bubble. It's this graphic showing median family home prices versus the consumer price index, cumulative inflation, as cumulative inflation stacks up. Why is that important? Well, it should track inflation because that's affordability. As wages track inflation, housing prices track inflation, and as it accumulates, that creates the affordability. Housing had become unaffordable. No one thought at that time that we were in a housing bubble or that housing prices could come down, but they did. Do you wonder where this graph is today? I think I'd like to skip this one, especially in Seattle, but I'll go ahead and put it up anyway. You're not going to like it. When the data is released for June, we think it will be at another new record high. It's up 75% since the low in 2012. And what I'm going to say is not a forecast, it is a fact. If we go into a recession within the next 2 years, this is likely to end badly. I want to cover 5 warning flags that we're currently watching. I'm not a doom and gloomer. Kim knows that. At the start of this bull market, we went up to 95% invested. Throughout this bull market, we stayed roughly 85 to 90%. We're no longer that invested today. But I want to cover quickly 5 warning flags. At Investec, we track a large number of technical indicators and macroeconomic tools. But I only brought along 5. These are certainly not the only ones on the list. In your registration packet, there was a handout of an April issue titled Late Cycle Evidence. Most of those are in this issue. That's why we put that in there. The first is divergences. You heard Ralph Acampura mention that earlier, and we are seeing them. Surprisingly, we're not seeing them in bellwethers. Those are major stocks in the key sectors that commonly peak ahead of the market. I brought along this graph for a bit of good news. It is our Investec Bellwether Index, and I'm going to put the peaks in this index up there, going all the way back to the 80s, and you'll see that this Bellwether Index typically peaks ahead of the broad market indexes. The good news is that Investec Bellwether Index is not falling, so it's not confirming a bear market. The bad news is that that's about where the good news ends. I'm going to put up another chart that shows two divergences that we're concerned about. One of them Ralph mentioned earlier. This shows the Dow Jones Industrial Average, the Dow Jones Transportation Average, which is economically sensitive, and the Russell 2000 Index. What people would be surprised to learn today is that the Dow still has not hit a new high from its peak back in September. If you look at those two indexes, the transports and the Russell 2000, and I would agree with a comment made earlier, if they drop under the December lows, then we are likely in a protracted bear market that's going to get a lot worse. Second warning flag, leadership. I'm not going to talk about upside leadership, but downside leadership, because that's what helps identify high-risk markets. We have an index called our negative leadership composite. The dashed line on this will show you what it was telling us back at the market top in 2007. It was a very negative reading. It was showing what we call distribution. It's a high danger reading. Distribution will often appear during significant corrections, and we've had a number of those in this bull market. But it's the past 18 months that has us more worried. In spite of what, and this is surprising, the Dow is actually trading below where it was in January of last year. And the majority of stocks have been treading water for the past 18 months. And in the past several weeks, after the Fed reversed position in December and the market roared out in response to the Fed positive rhetoric, now again in the last few weeks we're starting to see that distribution reappear, that negative downside leadership. You'll see this, you can track this on the home page of our website. We'll put it up there occasionally. If that drops back down to minus 100 over the next 6 months, then we're headed for more trouble ahead. A third warning flag I'm going to put up, margin debt. What is margin debt? Well, it's money borrowed to buy stocks on margin. Why is it important? Well, it's tracking the speculative money, and you might call that the smart money. It tends to run with the market as it's running up, become more speculative. It runs up and it peaks historically with the market peak or just prior to the market peak. And what worries us about this is that those past market peaks were pretty significant market peaks, and the fact that it peaked in January of last year. This is another warning flag to watch. It's released about the third week of every month. If margin debt drops under those lows of the past couple of years, then it means the smart money is heading for the exits, and you need to take more defensive steps in your own portfolio. The fourth warning flag, monetary policy. You've seen the headlines about the inverted yield curve. Let's put it in a graph. This next graph will show the 10-year T-bond yield minus the 3-month T-bill yield, going all the way back into the 1960s. That yield spread has gone negative. And why is it important? Well, every time it has done it in the past, almost every time except for 1965, we have gone into a recession in the next 18 months. Why is that a bad thing? Well, that precursor recession you're starting to see in the headlines, people are either endorsing it or poo-pooing it. I don't like just taking a warning flag like this, throwing it aside and saying this time it's different. Those are the most dangerous words on Wall Street. I'm going to show you a simpler picture. One directly from the Federal Reserve Bank of New York. It's called their yield spread model. They use it, it's called a probability of recession. We used this in 2007 as a warning flag to become more defensive. This is what the Fed's yield spread model shows for the probability of recession in the next 12 months. We calculate the number for June coming out at 34%. And if that graph does not make you nervous today, then nothing will. The last warning flag to watch I'm going to put up here is consumer confidence itself. That is, how consumers feel about the present. I put this graph up, and of course we're back up in the region that we saw in the late 90s and at the tail end of the 1960s. It's not going to give you advance notice of the market top, but if consumer confidence starts falling sharply, you will see it in the headlines, and if that happens between now and year end, and you haven't made your portfolio more defensive, then you'd better do it. And I know the headlines. Wait a minute, don't worry about it. The Fed is already talking about cutting interest rates. Don't worry. Well, there's a secret I want to share with you. Monetary policy is a very dull tool. It's like cutting a cake with a baseball bat. And the end result is usually just as ugly. Do you remember the tech bubble back in the late 90s and 2000? As soon as the Fed started seeing the bubble deflating and saw potential for an economic downturn, the Economist magazine ran this cover, Greenspan to the rescue. Now, everyone thought that Alan Greenspan's Federal Reserve could prevent a recession and stop the air that was going out of the tech bubble. It didn't. Of course, the NASDAQ lost well over 80% of its value, and we went into a recession about 3 months after this cover. And let's look that back and look at 2007, the last economic cycle peak. In October 2007, here is a graph of the Dow versus the discount rate. We were in a 5-year bull market, and this snapshot shown here is right at the market peak. This is, as I mentioned, 3 months after we published that July issue titled Bear Market Warning Flags. And the Federal Reserve note had already started cutting interest rates. Never have we gone into a bear market after the Fed started cutting interest rates. So no one thought we could have a bear market. But in spite of 9 more discount rate cuts, they couldn't prevent what was happening, either economically or from an investment standpoint. Investing is not about hitting home runs. I've been running the research firm for almost 40 years now, and we added the money management firm 25 years ago. It's about safely capturing the upside profits in a bull market, and more importantly, protecting those profits before the next bear market does its damage. It's about managing risk. It doesn't matter how much you've gained in this 10-year bull market if you give it all back when the next bear market hits and does its damage. So here is our safety first strategy for 2019. First, reduce allocation to your comfort level. 10 years ago, June 2009 at the start, we were 95% invested. Today, we're under 70% invested. We're over 30% cash, T-bills, safety of T-bills. That's not market timing. And I'm going to share another secret with you. Warren Buffett's Berkshire Hathaway, it also is holding over 30% cash today. Secondly, diversify into more defensive sectors. And finally, focus on value stocks, not momentum stocks. And yeah, that probably precludes going out there and buying the chewy IPO stocks. If you want more insight on how to manage risk in your own portfolio, members of our own portfolio team flew over, that is the Stack Financial Management, which is associated but independent of Investec, flew over. They're doing 2 workshops. Both of them are in this room on how to manage risk in your own portfolio. And the one, that's this afternoon at 1:45 p.m. There's another one at 8:15 tomorrow morning on how to identify that next great buying opportunity, because if we get through this, or once we get through what I think is a market problem ahead, I think we're heading toward another great buying opportunity. And the last point I want to add to this safety first strategy is simply this one. My point this morning is to watch for those bear market warning flags, because objects in the mirror may be closer than they appear. Thank you. What's that? Kim said we have a couple moments for a couple questions. Yes. Politics and the economy. You know, we've gone back and we've done a lot of analysis on politics. And you can draw a lot of conclusions depending on what era or what time you pick to run over that analysis over. I don't think it's going to matter. Where it would matter, and I'm going to say this kind of universally, I'm going to say it on politics, I'm going to throw tariffs in there too. Where it will matter is if it has a major impact on business confidence or on consumer confidence. That will determine whether we go down faster or whether we hold up longer. Yes? What sectors do we consider to be bearish? The Stack Financial Management team does a lot better job on that. I stay away from the portfolio construction, but I can tell you historically, the sector that does the worst in the last year of a bull market, universally, is the financial sector. That doesn't mean you avoid all financials, it means you underweight them. The other thing to keep in mind is that if we are possibly going into a recession, consumers are going to retrench. You'll see that drop in consumer confidence. What happens to consumer spending? It contracts. The consumer discretionary stocks, a lot of them are doing great to now, but I think they're the higher risk holdings in your portfolio going forward. So those two sectors, I would be careful or unwind some of the holdings in. Thank you very much. What? Okay, Kim's going to keep me up here. Yes. You mentioned defensive sectors. Let's talk about the defensive sectors. And again, the SFM, Stack Financial Management team, is a lot better at this. They actually dial down not only the sectors, but this afternoon at 1:45, they'll even get into the industries within those sectors. Historically speaking, healthcare is one of the most defensive. The problem is it's also one of the more overvalued today. Utilities are also one of the more defensive, and utility stocks are actually holding up very well. Staples, and again, the problem with staples is a valuation problem. So you have to be careful about just saying, well, let's buy those defensive sectors. I think you have to dial into the sub-industries to find those best buys. Let me take one last question. Yes? This is going to surprise some of you who haven't known me for the past 40 years. If you're an investor in your 20s and do you just stay the course and hold it, dollar cost averaging is your best friend. And if you're in your 20s and you're putting money aside every month or every quarter into the market in what I would call a good value or a good blue chip ETF, just keep doing it. You know, until you get into your 40s or 50s or into retirement and you have that large portfolio, and that dollar cost averaging is not going to protect you and it's not going to save your portfolio. The worst thing that can happen is to be 10, 15 years from retirement and then lose half your portfolio and realize your entire retirement plan just changed. So if you're just starting out, hold the course, but I'm going to tell you, because you weren't around in 2009, holding the course means holding the course, even when you see those headlines that the end is near. Okay? Thank you very much. Yeah.
Because Trump is a candidate that nobody expects.
Let's.
Can we get through the
Let's talk about presidential election years. And I'll tell you, I know Ralph Ackenbrook could get up here and recite the statistics better than I could. Historically, there is a 4-year presidential cycle. They all know it. All presidents generally try to use it. And if you step back more than 10, 15 years ago, it worked great. Every president knows if you're going to have a recession, get it out of the way in the first year or two of your presidential term. So when you're running for re-election in the next 2 years, you're recovering out of that, consumer confidence is rising, and it paves the way to the White House. The problem is, this time around, we have just the opposite. Now, I don't care who you voted for out there, but in November 2016, when everyone thought that the world might end, or a lot of people thought the world might end, depending on the bickering and the fighting and everything, right after that election, the NFIB Small Business Conference took one of its biggest jumps in history. Consumer confidence took one of its biggest jumps. It basically told us this bull market just bought another leg. We were actually increasing our allocation prior to that election while everyone was retrenching. But I think that leg is pretty much behind us now. And what worries me today is that I think those positive gains that normally come in the last 2 years of a presidential term, which is where we are now, I think we've already seen those. I think we've already bought that positive uplift. And the fact that consumer confidence is near the highest level in 50 years worries me, because the higher the level of confidence, the higher level of expectations, the greater the room for disappointment. Thank you.